Hey guys, I'm Roger Herring. I am the investor's accountant. Welcome to this edition of Ask Roger. That's where you get to ask me a question about taxes, asset protection, wealth building, generational wealth, all the things that we love to talk about right here on this channel. So today I've got a question that comes from Davis off of Facebook, and he wants to know, do I really have to have one LLC for each one of my properties? Great question, David, and I'm asked that all the time. Honestly, LLC strategy is the most often screwed up thing that we see in our practice. And no, I don't believe there needs to be a one-to-one relationship of one property per LLC, at least in the long run. There are some benefits to that in the beginning. Okay, so why don't we just go to the whiteboard and talk about LLC strategy in general. All right, let's go to the board.
All right, everyone, here we are at the whiteboard. And, to explain LLC strategy, I'm going to use Mark Kohler's diagram. This is called a trifecta. It's created by one of my mentors, Mr. Mark Kohler, CPA, JD, and it explains the layout and how things flow. Now, at the base of the trifecta is your 1040. Over on your right, you have assets. And over on your left, you have ordinary income. Now, I like to use this diagram because it clearly lays out the differences between the two and how we set up. And, people come in, well, how many LLCs do I really need? Well, what kind of businesses do you do? What kind of assets are you trying to protect? You see, of the 4M strategy, this goes with maintaining wealth because the LLC is a strategy. It's actually two strategies in one. It's what will protect you from those that want to sue you, but it's also going to help protect you from those that want to tax you. So let's talk about LLCs, and then we'll talk about how many properties per LLC. All right, here we go. So let's say that I have a business and it is an ordinary income business. It might be an accounting firm. It might be a law firm. It might be a real estate brokerage. It might be a flipping business. It might be a wholesaling business. It might be any one of those things. And we're going to make this an LLC. Why? In many states, the LLC has better protection than a straight corp or an Inc., but it's also very flexible. Why? Because it can be taxed as whatever we say it's going to be taxed as. It can be a sole proprietorship or what we call a disregarded entity, which we do use in some cases. It can also be a partnership. It can be a C Corp, which we don't use that often except in specific circumstances. And it can be an S Corp. Now, here's the rule of thumb. If it's ordinary income, if my income is below $30,000, I'm just going to be an LLC. If my income is above 30K, I'm going to make this an LLCS. Now, I only want one and only one LLCS. If I have multiple businesses, let's just use an example. Here is the Investors Accountant LLC. We'll call it TIA. And underneath that is a business called Investors Accounting, IA. Also under that is a business called TIA Media. And also under that is a business called RT Herring and Associates. All of these have different purposes and different revenue streams, but they all flow up to my S Corp. So these are three different LLCs to protect the revenue stream. They are for taxes disregarded. Now, Roger, what if I went into business with my buddy? Do I want an S Corp? Absolutely not. If you go into business with your buddy, what you're going to do is create a separate LLC partnership. And here's your buddy's part. It's going over here off the chart. But your ownership in this ordinary income type business, say you're flipping properties together, is going to flow up to your S Corp. Well, what about my wife? Your wife your spouse, your husband, whoever you are married to can be a member of the S Corp. In fact, the only other member of that S Corp, the only other shareholder, should be someone you're married to. And you don't even have to make them an owner. We might make them an employee because we're doing this for tax planning purposes. You see, you don't want somebody else that you are not married to in your S corporation because it's going to become your primary tax planning entity. Now, that's on the ordinary side. Let's go over here and talk specifically about Davis's questions. Do I need one LLC per property? Well, you know what, Davis? In the beginning, if you only have, let's say, 2 properties, then you're going to want 2 LLCs. Why are you going to want 2 LLCs? We're following the first rule, which is called eggs in the basket. I'm just going to put eggs. Okay. Now, if you are a single person, these 2 items will flow down here to your 1040 and go to Schedule E. If you're married, however, and you live in a state that is not a community property state, which is most states, then what we're going to do is we're going to create a multi-member LLC. And who owns this? Husband and wife. And now these LLCs are children of the parent LLC. Now, Roger, why would we want to do that? Because Schedule E is audited more often than the partnership tax return. In fact, the partnership tax return has the lowest audit frequency in the entire tax system. So what we just did is a move to reduce your chances as you grow of getting called in by the IRS. So let's just assume that we're going into partnership mode. All right. So in the beginning, we have 3 LLCs. Now, that's the eggs in the basket rule. Let's say that I add a 3rd LLC. You know what? I am probably, when I add that 3rd property, going to create a 3rd LLC. Now, let's just make some assumptions. Next thing we're going to look at is equity. And here are the assumptions. Let's just say that this property has $50,000 in equity. This one has 20% or 20,000, and this one has 40,000. What you have to do is come up with the level of equity that you can tolerate being at risk. And as we buy more properties, we're going to slowly add to each of these LLCs until we hit our tolerance level. Then we're going to add another LLC. So let's say that maybe our tolerance level is $100,000. So when I buy my next property that is at, say 40,000, let's put it right here with the lowest equity one that we have. So now we've got 60K in this LLC, and we have 2 properties. Now, let's say we buy another LLC, or excuse me, we buy another property, and that property is also worth 50,000. Well, we decided that 100 is our tolerance. So here's 100K, and we got 2 properties. Now, what if, say, we bought 2 more properties and they had 30K each of equity? Well, we can put them over here. And now that brings us to 100K. And we've got times 3. And let's say we bought one more with 40,000. We would put it right here. So now we're at 100K. And this becomes times 3. Whew, now we've got 100K inside of each one. That tells me that the next property that we buy, we're going to create a brand new LLC. The third thing we're going to do is we're going to look at risk. So a property that you can eyeball every other day that's right down the street that the same little old lady has lived in for the past 25 years, and you call her Aunt Betsy. She's been there so long. That has a whole lot less risk than something downtown where your copper is stolen every other week. All right. So something like that. I've got a buddy that has a frat house at University of Alabama. Yeah. So if you bought a frat house, would you put it in with your single families? Absolutely not. That has high risk. That's going to go in an LLC all by itself. Now, number 4, cash flow. Would you agree that a single family long-term rental has a totally different cash flow than a short-term rental does? So if I've got a short-term rental, I'm probably going to set up an LLC just for Mr. Short-Term Rental, okay? Because he has different cash flow. And then there's commercial. Commercial, in my definition, is anything that has more than 5 doors or an office building, etc. You know where I'm going. So when you're doing commercial is always in its own LLC. It is never combined. All right. So the answer is, in the beginning, yes, you are going to have, Davis, one LLC per property. Establish your equity tolerance, follow the rules, and then you decide how many LLCs you want based on what you are comfortable on. I've got clients that literally have 12 properties with about $25,000 in equity each, and they put each one of those things into its own LLC because that's what made them comfortable. And I've got clients that have 300,000 plus in the same LLC and multiple properties because that's what they can tolerate. It's up to you. All right.
Guys, thanks for joining us today. I hope you have learned something. Remember, click the link right down below and you can score a free PDF of some of our favorite tax strategies. Until the next time, Roger out.